Hey everyone, welcome back for another deep dive. Today we're tackling something that I think a lot of traders struggle with, and that's really getting a handle on how to evaluate a trading system before you actually put any real money at risk.
Yeah, it's critical, right? You want to make sure you're not just chasing fool's gold.
Exactly.
Yeah.
And the technique we're diving into today is called system parameter permutation, or SPP for short. It's all about stress testing your system, so to speak. And for this deep dive, we're going to be looking at a paper by Dave Walton.
It's a really practical paper. He focuses specifically on systematic trading. So think rule-based trading systems that you can code into algorithms.
Right. So taking the emotion out of it, making sure the results are, testable and verifiable.
Absolutely.
But rules are not. I think the thing that keeps most traders up at night are these two big questions. One, will this system actually make money over the long haul?
Yeah.
And two, and this is a big one, what's the worst that could happen in the meantime? While I'm waiting for those long-term gains to materialize.
Right.
So what are your thoughts on that? I mean, those are the questions that keep me up at night for sure.
Totally. And Walton addresses these questions head on in the paper. And he also brings up a really important point that I think might make some traders uncomfortable.
Oh.
He suggests that the way most of us typically develop trading systems can actually lead us to some overly optimistic expectations.
Oh, so you're saying we might think we found a gold mine, but it's really fool's gold?
Yeah, there's a big but there.
Okay, I'm sensing the but come in here.
Yeah, the but is this thing called data mining bias, or DMB. It's this sneaky little gremlin that can make a system look fantastic in a backtest, when you're testing it on historical data.
Uh-huh.
But then it flops miserably when you start trading it live.
Ouch. So data mining bias, DMB. This sounds like something we need to understand. Can you break that down for us a little bit?
Sure. So there are two main things that need to happen for DMB to rear its ugly head. First, you have randomness in the markets, which that's a given, right?
Yeah.
And second, you as a trader, you're probably trying out a whole bunch of different rules and parameters, trying to find that best combination for your system.
Right. Yeah. So like testing different indicators, different look-back periods, different entry and exit signals. You're playing around with all those knobs and dials.
Exactly. And the problem is when you combine that random market data with trying out all those different parameters, well, it can lead to performance metrics that are way too optimistic.
Okay.
Your system might look amazing on paper, but it's essentially memorized the past instead of actually capturing a real edge.
Oh, so it was like picking the best athlete based on just one single game where they just happen to be on fire.
That's a great analogy.
But, their future performance is probably going to be much closer to their average, not that one standout game.
Exactly.
Okay, so is this just a theoretical problem, though? Or is there evidence that DMB is actually a real threat for traders?
It's a very real threat. There was a study by Aronson back in 2007. He tested over 6,000 simple trading rules on the S&P 500 over a 25-year period.
Yeah.
And guess what? None of those 6,000 rules had a statistically significant edge after accounting for data mining bias.
Wow. That is a serious wake-up call.
Yeah, it's pretty sobering.
So how do we fight back against this DMB monster? What tools do we have in our arsenal?
Well, there are a few methods that have been around for a while, like cross-validation. You might have heard of bias compensation, bias deflation, but they all have their limitations. For example, cross-validation, it's a popular one, but it doesn't use all of the available data.
Oh, okay. So why is that a problem? Is it kind of like judging a book by only reading half of it?
Yes, you got it.
Yeah.
By not using all the data, we might be missing out on some important patterns or some market nuances. And this is where SPP comes in. SPP might actually be a more powerful solution.
Okay, I'm intrigued. Let's unpack this SPP thing.
Yeah.
What exactly is it and how does it work?
All right, so SPP stands for System Parameter Permutation. And it's a technique that really leverages that system optimization process, which, as we've talked about, that's where that data mining bias can really creep in.
Right.
But instead of just picking the best performing parameters, SPP actually uses all of them.
Also, instead of focusing on just that one lucky game, we're looking at the athlete's entire career.
Exactly. And here's the key. Instead of using that absolute best performance, which could just be a total fluke, SPP uses the median performance.
Oh, the median? Okay.
Yeah, the median is that middle value, so it's not as easily swayed by those extreme outliers.
So we're basically saying, okay, based on all these simulations, what's the most typical outcome for this system?
Right. No more wishful thinking.
I like it. No more wishful thinking.
We're taking a grounded, statistically sound approach.
That makes a lot of sense. So it's
Yeah.
like finding the most typical performance instead of chasing those rare, exceptional results.
Exactly. And by analyzing the distribution of all these different parameter combinations, we get a much richer and more realistic picture of how our system might actually behave in the market.
So it's not just a single point estimate anymore. It's like a whole range of possibilities.
Exactly. It's what we call sampling distributions of those system performance metrics. And these distributions give us both long-term and short-term performance estimates.
All right, so how does this actually work in practice? Can you walk us through the steps of how you'd actually use SPP?
Sure. Let's say you've defined your trading system. You've got a few adjustable parameters. Maybe it's the look-back period for a moving average. Maybe it's a threshold for an indicator.
Right.
The first step is to define the range of values that you want to test for each of those parameters.
Okay, so like I'm going to test moving average from, 10 to 50 days.
Exactly. And then you'll divide those ranges up into specific values. So maybe you'll test every 5 days within that range. Now, here comes the interesting part. You're going to run an optimization, but instead of just picking the best one, you run a historical simulation for every single combination of those parameter values.
Oh, so you're going to have a ton of simulations.
It can be a lot, yeah. But that's the power of SPP. You're not throwing away any information, you're using all of it. And then all of those simulated results are combined to create a distribution for each performance metric.
Okay.
So you're not just looking at the average return, you're seeing the entire spectrum of potential returns.
That makes sense. So we're seeing how it performs under all these different variations.
Exactly. And this gives us a much more realistic, robust understanding of the system's potential. We can see the most likely outcome, but also those worst-case scenarios.
This is really starting to click for me. It feels like a much more thorough, statistically sound approach than just relying on, single optimized backtest.
It is. And what's even more exciting is SPP can give us insights into both the long-term and the short-term performance of our system.
Okay, I definitely want to hear more about that. But I think we need to take a quick break, and then we'll come back and explore how SPP can reveal those critical long-term and short-term insights.
So we've run all those simulations with SPP. We've got these, these sampling distributions, and now we can start to answer those big questions. What's a realistic expectation for our long-term performance? And what could go wrong in the short term.
Right. Yeah, those are the million-dollar questions.
Yeah.
So let's start with the long term. How does SPP help us there?
So for the long term, we look at the median of the distribution for each performance metric. And remember, the median is that middle value, so it's not swayed by those crazy outliers like an average might be. So this gives us a much more stable and realistic estimate.
Okay, so we're saying, okay, based on all these different simulations, what's the most typical outcome I can expect?
Exactly. We're not getting seduced by that one amazing run where everything went perfectly.
Right.
We're being grounded, statistically sound.
No more wishful thinking. I like that.
No more wishful thinking.
So what about the short term then? How can SPP help us kind of plan for those inevitable bumps in the road?
This is where it gets really interesting. SPP allows us to do what's called worst-case contingency analysis. We can look at the distribution and say, okay, what does the worst 5% of outcomes look like? Or even the worst 1%, if we're really risk-averse. This helps us understand, how much pain we might have to endure to reach those long-term gains.
So instead of just hoping for the best, we're actually preparing for the worst.
Exactly. We're asking ourselves, can I handle this? Can I stomach these potential short-term losses in order to get to those long-term goals? And STP gives us the data we need to actually make an informed decision.
This is making a lot of sense to me. Can we see how this plays out in a real-world example, though?
Absolutely. The paper uses a momentum-based trading system. It's based on this idea of relative momentum, which basically means assets that have performed well recently tend to continue outperforming. And this has been validated across lots of different asset classes.
Okay, so this isn't just some, random theory. It's actually got some evidence behind it.
Right. So this example system, it looks at a basket of ETFs, picks the top performers based on a specific momentum indicator, and then rebalances monthly. Pretty straightforward.
Okay, got it. So where does SPP come in?
So instead of just looking at the system's performance in a single backtest, SPP runs thousands of simulations with different combinations of parameters. And this gives us that much richer understanding of, all those possible outcomes.
Okay, so I'm picturing those sampling distributions we talked about.
Exactly. And when we compare those SPP results to the traditional out-of-sample testing, we see some interesting things.
Oh, really? Like what?
Well, for one, the STP estimate for the long-term compounded annual return is actually lower than what we get from traditional testing.
Oh, interesting.
This really highlights how data mining bias can sneak in and pump up our expectations.
Right, so it's kind of bringing us back down to earth a bit, giving us a dose of reality.
Yeah, a little dose of reality.
I like that.
Which can save us a lot of heartache down the road. But here's the other side of the coin. The SPP estimate for the maximum drawdown is actually higher than the traditional testing estimate.
So SPP is saying there's a chance of losing more than we initially thought.
Exactly. It's not just about chasing those high returns. It's about understanding and accepting the level of risk that we might have to take on to get them.
Okay, so SPP is not sugarcoating anything. It's showing us the good and the bad.
Yeah. It's about making informed decisions with our eyes wide open.
I like that.
And when we do that worst-case contingency analysis using SPP, the results are really interesting.
So give me an example. What kind of worst-case scenarios did SPP reveal for this momentum system?
Let's say we're looking at the worst 5% of potential outcomes for a given calendar year. SDP tells us there's a chance we could see a negative compounded annual return of almost 13%.
Oh, wow. That would hurt.
It would. It's something that we might not see in a traditional backtest that's, just optimized for the best outcome.
Yeah.
But by having this knowledge beforehand, it allows us to prepare mentally and financially for those rough patches.
Right. So instead of being blindsided, we can adjust our expectations, maybe our risk management, our psychology even, to handle those tougher times.
Exactly. SPP allows us to be proactive instead of reactive. We can make data-driven decisions about whether we even want to trade a system or not. And crucially, when to potentially stop trading it if things start heading south.
This is so valuable. I feel like I'm looking at systematic trading through a whole new lens now.
I'm glad to hear that. There's actually one more thing about SPP that I think is worth talking about. It's about what makes SPP so effective. Like what sets it apart from other methods.
Yeah. Okay, let's dig into that. Okay, so we've seen how SPP can give us a more realistic picture of a trading system. But what really makes it different? What's going on under the hood that makes it so effective?
That's a great question. A lot of these traditional methods, even some of the fancy ones like bootstrapping or Monte Carlo simulations, they often rely on this assumption that a single historical simulation is a good representation of what will happen in the future.
Right.
But as we've seen, that data mining bias can really distort things.
Yeah, it's like assuming that just because you flipped heads 5 times in a row, you're definitely going to get heads on the next flip.
Exactly. And some of those techniques, they also struggle to really accurately model the complexity of a real-world portfolio. Things like changes in buying power, how different assets are correlated with each other, how past price movements might influence future ones. All these things can have a big impact on performance.
Yeah, so they're not really capturing the full picture of what happens when you're actually trading.
Right. SPP tackles these challenges in a couple of really clever ways. First, it leverages this statistical concept called regression to the mean. Remember how we talked about those extreme performances often being followed by something closer to the average? STP takes that into account by generating this whole distribution of results from all those different parameter combinations. So it helps us see how much of that amazing performance might have just been luck.
So it's like saying, hey, let's not get too excited about this awesome backtest. Let's see how it does under all sorts of different conditions.
Exactly. And the second reason SPT is so powerful is that it uses all of the available market data, which helps to minimize the standard error in our estimates, gives us more confidence in the results. And this is a big difference from something like cross-validation, where you're splitting the data into these smaller chunks.
Right. So SPP is giving us that more comprehensive view because it's not throwing away any data.
Exactly. And that's especially important when we're dealing with things like regime changes in the markets. The more data we have, the better we are at handling those shifts and seeing how our system might perform under different conditions.
This has been a real eye-opener for me. SPP feels like a much more mature and robust way to approach system development than what I've been used to.
I think so, too. It's about shifting our mindset from chasing the best to understanding the most likely and being prepared for the worst.
Well said. I feel much better equipped now to approach systematic trading with, a clear understanding of both the opportunities and the risks.
That's great. I mean, knowledge is power, right?
Yeah.
Especially when it comes to trading.
Couldn't agree more. And speaking of knowledge, I think this is a great time to remind our listeners about Dave Walton's paper. If anyone wants to dig deeper into the nuts and bolts of SPP, I highly recommend checking it out. It's a fantastic resource for anyone who's serious about systematic trading.
Absolutely. It's a must-read.
So as we wrap up, I want to leave our listeners with a thought. Knowing that even the most well-researched systems can have those periods of underperformance, how does that change your approach to trading? What adjustments might you make? Maybe to your process, maybe to your mindset to help you navigate those bumps in the road.
That's a great question to ponder. It really gets us thinking about our risk tolerance, our goals, and how we define success in the markets.
Well said. On that note, I think it's time to wrap up this deep dive. Thanks for joining us on this journey into the world of system parameter permutation. Until next time, happy trading, everyone.